things have been shaping up apparently since whatever time that is. It's not very clear, but we'll figure it out. Yeah, since I fell asleep. That's funny. 10, I was 10, I didn't fall asleep at 10. Anyway, so since 10 o'clock, we've been lifting up pretty steadily. And I don't quite know why. I don't know if there's any reason for it. Oil is still down pretty badly. Natural gas. Wow! Look at natural gas. Holy shit. That's funny. Gasoline, but that's good. I've been telling people 220 was the bottom, and then I felt kind of silly when it went down to here, but now it's back, so we're good. This is why we don't panic out of things. Let's see. Get back into that. Portfolios. Your Chrome is up to date. Well, that's nice to know. Sort of chart. Yep. No, there's no energy report today. Fed, here's my chatbot. Is my chatbot still alive? He doesn't know me either. Add your email. No, you know me. Click on the email. Check your email for a login link. Oh, I'm not a plus subscriber. I'm a regular subscriber, so it's telling me I gotta wait, I guess. Okay, well, that's back to normal. I haven't had that in a while. It's been a whole week since I've had to wait for anything. Such a pain. All right, so back to the futures. Where are we? Okay, so bonds are here. Softs are here. Look at lumber is getting nailed. The housing, lack of housing. Sugar, big crash on sugar. How's that look on? Not that much, but big crash from topping out over here. Coffee picking up nicely, which we bet on. Orange juice, we knew it was going to go like that. That was obvious. Look at metals. These are, look at daily. So gold and silver in a big pullback patterns, but they should stabilize around here, I think. Meats. Cattle still really expensive, like really expensive. And that means grain. Soybeans way up. Soybean oil, soybean meal. Wheat not so bad. Oats not so bad. That's interesting. And good old dollar back over 104 after having a vacation down at 101 for a while. And that's where we are, folks. So let's see if anybody has any questions. Nope, no questions. All right, good. We don't have to do anything then. I'll just go back to sleep because I think I was pretty tired. It was about a half hour before, and I just laid down because I wanted to rest for a few minutes, and before I knew it, I guess I fell asleep. Did not even realize I was tired. Never should have laid down. That was my mistake. So what is this? So here's a short-term portfolio. Let's look at the adjustments we made in the portfolios. That's a good idea. Shit. Really not working? Welcome to ChatGPT. Log in. That's me. And that's me. You do know me. See, it works. We're experiencing exceptional high demand. Well, that's pretty good. Been doing all kinds of fun stuff with that today. Just in case we need you. So where are we? PhilStockWorld, right? So look at Phil's posts. And last week, portfolio review. All right, so this was the short-term portfolio. Just want to see if we had any adjustments or anything to make. No, I'm sorry. That's a money talk portfolio. 'Cause I'm like, why would Sharon Blau be in the Simon Property Group be in the long-term portfolio? So the money talk portfolio was nicely balanced, and we're up a couple 100% in that one. Obviously, we don't make any changes. I'm on the show March, whatever the beginning of March is, March 1st, I'll be doing the show. So that's next week. And then we'll make some adjustments. That means I got to start thinking about what we want to change here. We're going to have Yeti earnings tomorrow morning, so we'll see how they do. Sophie Logitech, I guess, got to go over all these earnings. Haven't we just talked about Intel? Now, here's the thing on the money talk portfolio. We have a lot of cash on the side, 263,000. We're not heavily invested, only $68,000 worth of actual securities. And the question is, what do we want to do with Intel? How is Intel set up? We have 40 short calls for January because we weren't expecting that much out of it this year, but those are already kind of dead. So I think we're going to pull these and maybe sell something else. These haven't changed that much. So is it even worth it for Intel that we sold the 40 calls? Do we want to just pull them off? I think we do at this point. But is that the only move we want to make? If we want to pull the 40 calls back, we have the 30 calls. There you go. No, I'm sorry. We have the 20 calls. So we have the long 20s, the short 30s, and that's our goal. And Intel is now at 26. So there's really nothing else for us to do, but it does make sense to buy back since this would seem to be a support line here. And since we're generally happy with Intel, we think this is since we have the 20-30 spread, that's all we need in 2025 to make our money. We may as well buy back the short 40s now. That's the only thing that can hurt us. And we've already made 88% of what we expected to make. So that's a change we'll certainly make. And we'll see about the rest. I'll have to do an analysis later. Here's the short-term portfolio. So in and of itself, I don't think we made any changes, did we? No, because we made the changes a week ago Tuesday. That's why. We made these changes earlier than this portfolio review the week before, because just in case the market pulled back, which it kind of did. In fact, that's pretty good timing, right? Because when did we do that review? So this is the 22nd. Last week was the 14th. Is pretty much the day we did the portfolio review, right? Valentine's Day. And the week before is when I decided that we should up the short-term portfolio. So good on me, right? Smart. I don't know if we're going to see much of a reflection of that right now. We're at 1879%, and we were at, when we did the review, we were at 1844. So yeah, 3888. And now we're at, without touching it, 3959. So 70,000 bucks. We're up 70,000 bucks from last week. So nothing exciting, but whatever. At least it's not going the wrong way. Because these are our hedges. And Coinbase is all over the place. I think they're down today. Coin is down today. But 59 bucks here, and it was $59 last week. So it's basically back to where it was before earnings. Anyway, so it is what it is. And UNG, of course, is getting killed. We'll have to think about that also. So nothing much to change there. And I think we added up our protections. Did we? Did we not? $5 million downside protection against a 30% market drop. And I just ran over the numbers yesterday, and we talked about being a good couple of $1 million of protection on a 20% drop. So that's key. That's the real key we're looking for versus what we have in the other portfolios. The future is now portfolio. I'm concerned with what we changed, not what we didn't change. We sold more puts on Ford because it was so low. On CN, what do? We bought back the short calls just to let ourselves have some room to run, and we're waiting for the earnings here. Here's Coinbase. Okay, no, we just had mediocre earnings out of them. CRISPR, but you know, Bitcoin's coming back. Then they're lagging behind, so I think they'll come back also. Oh wow, really didn't make many changes, did we? It's interesting. Okay. So then I go back, I'm like, oh wow, I thought I was gonna, because I did. I was in the mindset that we were gonna change a lot of things, and we ended up not changing many things because we're generally happy with the portfolios. The butterfly, I don't know, you know, whether it's holding up or not in the downturn. That's what we'll have to do the math on and figure out if we're right. Butterfly portfolio, lots and lots of positions here, but we didn't change much. IMAX, we sold some puts. Oh, we already have that position. We sold some puts. Disney, we sold some calls. Oh, because we were on caps and I decided to cap it, which turned out to be a very good move considering we pulled back considerably on Disney. Gilead, again, we sold some calls because I felt this was going to be toppy, and that we aggressively sold the May 80s, even though we were higher than 80, because I was expecting a pullback. You know, just because you like a stock, you still got to be able to realize, like, hey, this thing went up from, you know, 65 last quarter or whatever it was, but you know, it went up from 65 at that point from consolidation. Then it went all the way to 90. That's like 50%. That's a lot. Did it really deserve to be up 50%? And you got to look at it realistically and say, no, they didn't do anything that added 50% value to the company. They just came back into favor. But that doesn't change the fact that we did, you know, we believe that the correct price is basically 80. And we also expect a market pullback. So it's very simple. We just sold some short calls to cover the gains. We had, and we had already done that. We sold February 80s, right? And those expired last week. And the stock was much lower, so that was good. So then we let those expire, and we sold now the other 80s to cover because we felt we were going to get a pullback. We didn't want to be less aggressive. We wanted to have that sale, and it's only a half sale, but we're aggressive on the half sale because if we're wrong or if we're right and it goes much lower, we can sell the other half and cover more. And you know, we're doing that on every single stock. We're saying, is it too high? Is it too low? You know, what's the range? Where should we be? And if we're not sure, we sell a little. But whenever you can pick up some premium, selling some, you know, calls and puts, why not do that? I mean, it's just money in your pocket. And that's why the diversification is so important, because if you have a diversified portfolio with lots of stocks, you may feel some are too high and some are too low, but if the whole market goes up and down, you know they're all going to kind of go up and down together. But some we sold puts on, some we sold calls on, so we could be right. Some we sell puts and calls on. You don't lose on both sides, not too often. Whirlpool, interesting, and also dropped quite a bit. We bought back the short calls, and we gave them a chance to go back over 160. They have not done that. They've gone the opposite direction. This is a weekly chart. This is not really the opposite direction because it was from last week, but we haven't gone anywhere. The dividend portfolio, we did not make any changes. Hello? No changes at all. Wow. That's impressive. See, and Simon Property Group, we think is bottoming there. JXN is just ridiculous, like going rocket to the moon. AT&T is actually AT&T is consolidating for a breakup, I think, over 20. Won't that be crazy seeing AT&T over 20 again? Dow is just Dow, VTRS. It says our goal. It's at our goal a year ahead of schedule, but but it's only net 40,000 on the $60,000 spread. So in other words, if this thing holds, I don't know what the spread is. I guess it's 12. Oh, I see. So we have the stock. We sold the $12. We didn't sell 12 calls. We sold the 12 puts. So those puts are expiring worthless. We don't have a cover. I think I was thinking the 12s were a call. We sold the 12 puts. We don't have a cover. We should cover these actually. Silly me. So I guess when I said at our goal, I must have thought those were calls, but they're not. They're puts. So that has to be revisited. Earnings portfolio. You try doing these things 4 weeks straight and see how you feel. Let's see. No changes to earnings portfolio either. Wow. Wow. It's funny because I realize like I must really love these positions. Crocs. So why do people hate Crocs so much? Yeah, in other words, like this is insane. Okay, so it's a great spread. It's net 10,000 on a $90,000 spread. Let's talk about stuff like that because when you guys are looking at these portfolio reviews, you really got to pay attention to these things. And I point them out, and it's just, if you're looking for trades, this is a great place to look for trades because we already like them enough to buy them, and they're doing well, and yet the risk is disappearing from the trade. When we took it, it was risky. We took this trade in January, basically, and the spread is the 100-130 bull call spread. Crocs is now at 134. It's 100% in the money. Okay, and we sold the $90 puts. Again, we didn't, at the time it might have seemed risky, but it certainly doesn't look risky now. And we sold the June 130 calls, which are at the money. So we sold a 1/3 sale of June 130 calls. And Mr. Calculator. See, this is what I'm waiting for. So the AI to be able to, so I can just say to the AI, so what does that add up to? And it's going to do it for me. That's going to save me some time. 181,950 minus 138. 150 minus 14,000 minus 19,700. Holy crap. Yeah, $10,100. So the spread is 30 times 30. It's a $90,000 spread, right? So if it comes in the money, it's going to be 90,000 bucks at 130. We're at 130. The short calls are at 130. We can roll them or we can sell more. We might even lower this cost basis down. If these expire at the money or close to it, we're going to make this money, and then we're going to sell more short calls and make more money. And we're going to get several chances to do that because we're only using 120 days out of 701. So this spread that's in the money, it's just so silly, right? It's like in the money. It's the 100-130 spread on Crocs. It's in the money right now. We sold short calls. So we've even covered the concept of it going down. In fact, we actually would love it to stay under 130 so we can just keep selling short calls. And we have a good 5-6 of those sales ahead of us that we can pick up a lot of. Oh, what was it? It was a lot. It was we picked up $16,000 on that sale. We can sell 5 more of those and pick up $80,000 more dollars. against a $10,000 cost so far. It's a phenomenal spread. Yet, even though the risk is gone, we started here in January. So it was low, where it was 110 when we started, basically. We started in January. It's shot up to 124. It's not hugely up, but we got through earnings. Or, no, maybe we didn't get through earnings. Let's take a look. Yahoo. Maybe they didn't have earnings yet. I don't remember. 4.5% today. No, we went through. They already had earnings because the next earnings in May. So we got through. So it's like such a thing. So understand that we went past earnings. Earnings were fine. They took off. I imagine that must have been from earnings. They took off. Everything looks good. The thing's in great shape. It's a simple spread. $10,100 on a $90,000 spread is still available with half of the risk factors that we took on originally already out of the play. That's crazy. Options are crazy sometimes. This is just free money. I mean, sure, it could go down or whatever, but $80,000 profit in 2 years on $10,100, and all the stock has to do is not go lower than it is now. And not only that, though, but the bonus potential of selling those short calls over and over, and those short calls haven't even paid us yet. We're losing money on the short calls. Maybe not today, but I mean, because wherever it is at 124, because it was 130. Well, it's down $10 since here, so probably a little bit different, but not that much. But the point is, you know, this money was still there to be made. You would still get $19,700 for selling that, more than the $16,700 we sold it for originally. You know, overall, we were up slightly on the trade. So I'd say today we're probably doing better than this. But, you know, the thing is, it's just sitting there. It's insane. I don't consider that a risky position for something that can make 800%. You know, and here's Jackson, way in the money, but it's still only 12.5 on a $20,000 spread. It can make $7,500 more, which is what, 59% at the end of the year. In fact, this year. So this spread, even though it's deeply in the money, in fact, Jackson is the 30-40 call spread. We're at 50. It's the 30-40 spread with the $25 short puts, and again, that is just free money. That's just 60% for doing nothing. It has to hold 40 and you make 60%. I mean, it's free money. I don't know why people don't want these things. You know, and that's why I say you don't always have to go running around looking for new trades and new things to buy. You don't have to sit there and watch, oh, who says something's hot and blah, blah, blah. Perfectly good trades right here that can make you a ton of money. Anybody who's not spoiled like people here are would be like, holy crap, that's a lot of money. You guys are all spoiled. Give you too many good trades. So Paramount earnings tonight, we'll see. So I guess the earnings were okay. they were not terrible anyway. Paramount's chugging along. Wheaton Precious Metals, $30,000 spread, 14.9. So there's 100% upside potential. And what was the deal with Wheaton? 30-45 spread. So we're a little bit out of the money here. The 35 short puts, those are still fine. And well, like I said, I mean, it's probably better now than it was then. But you could still make 100%, and they're this year. So it's 100% this year. Keep that in mind also. You got to watch the years because it's 100% in 12 months, not 100 in 10 months now. 100% in 10 months, not 22 months like the 2025s are. So that's a great rate of return, short time frame, a stock that we're very comfortable with. And as we just noted, there's a pullback in metals. right? And I think that we're bottoming. So if we're bottoming and it's a good time to enter, that's perfect. The long-term portfolio, also very few changes, very surprising. PAA, we bought back the short puts. We sold more puts, just because we just want. They ran out of gas, so the short puts that we had, these guys, the $10 puts, they don't have much gas left in the tank, right? They only have $1,500 left. We sold them for $8,400, so we buy those back and sell something we can make money on, because we're very comfortable that PAA is not going to roll back much. So instead, we sold the much more aggressive $15 puts, even though the stock's at 13, and we sold the $15 puts for $13.40. That gave us $5,300 to roll. Look, even though we have money in the portfolio, that's not the point. I like the trades to pay for themselves as much as possible. It's like the portfolio money is like for emergencies. I try to have the trade generate its own money if I'm going to do rolls and things like that. That's a good principle to go by, if you can. And if you can't, by the way, that means you don't like it enough. If you can't find something to sell or some way to make some money to pay for your rolls, it may mean that you don't like it enough to take a bigger chance. Like I like PA enough. I don't mind selling the $15 puts. I don't feel like that's a threat. So, 2 years from now, we think it'll be up to 15. It's only at 13 now, but we're comfortable with that. Not only that, though, when you sell the $15 puts for $3.40, your net is $11.60. So that's when I'm really comfortable. I'm really comfortable that $11.60 is a safe price. But then we use that to roll, and now in benefit though. We're using that to roll our January 10 calls. Oh, I'm sorry. We rolled them out a year. It's the short calls, not the long calls. We rolled the short calls that are January 10s because we just want to keep collecting the dividend on this stock. And we rolled those short calls out to the short $12 calls. And the the $12 calls are 2. And that's more than the dividend. So if they pull it away from us, we don't care. We'll just buy it again. But at the moment, it's $2. So therefore, if during dividends time they pull the stock away from us, we're like, okay, fine, we made $1. Instead of the dividends, we make $1. We're fine with that. And that's why it's not actually going to happen. And another year to collect dividends, which is $8,500 a year. It's $1 per year for the dividends. That's super mellow compared to what we mostly do in the LTP, but it's nice to have a couple of dividend stocks just for fun. Apple is Apple. Airbnb super took off. We added them pretty recently, and they took off when we took the 81. And again, it was a super conservative spread. What was the date? 8120. Oh, I'm sorry, January 20th. Okay, so we already had the short puts. That was how we initiated the trade by selling some short puts on 12/2. On December 2nd, we sold some short puts. They were doing well, and we didn't want it to get away from us. So on January 20th, we decided to sell some to buy an 8120 bull call spread. So let's see, where was the stock on January 20th? So it'd be right about here before it took off. So it was at 100, and we took the 8120 bull call spread added to the short puts, which we felt comfortable with. December, back here, is where we sold the puts. So we sold the puts, put our foot down at 80. It quickly went up to 100. We didn't want it to get away from us, so we grabbed the bull call spread and added that to our already successful short puts. And then they had earnings, and it rocketed even higher. But did we take a big risk? No, in fact, it's funny, I wrote it here. You don't have to take a big risk to make big returns. You can really do a lot more. You enjoy trading a lot more if you don't try so hard. Could we have made more money if we took the 120, 160 spread? Yeah, sure, but we still wouldn't be in the money. I'd rather be comfortable because, first of all, there's a couple of things. Because that's a lock, or it looks like a lock at the moment and probably will be a lock the whole time we own it, it means that we don't have to worry about hedging it. we hedge everything, but we don't really hedge everything. There are certain trades we think are safe that we don't need to worry about protecting because they're deep in the money and they have a margin of safety to them. So we're not really, you know, when I'm looking at my hedging, I look at all my trades and I think about how much risk I really have. And if something is like hugely in the money, I don't really count that as being something I have to hedge. I look at what I think I could lose as something I have to hedge. And there's also the question as to whether or not I, what's the word? There's also the question as to whether or not I believe that would I want to dump it if it went down? If Airbnb drops 20%, do I want to dump it or do I want to buy more? And if it's down with the market and nothing it particularly did on its own, then I'm going to be much more likely to want to just buy more of it or improve the position. So in other words, what you're thinking about when you're hedging is I'm thinking about what if the whole market drops? And it's not about if Airbnb drops, obviously I'm going to reevaluate Airbnb. If it drops by itself 20%, then I'm going to start thinking about why am I in this position and what can I do? But if the whole market drops and drags Airbnb down with it, well, then that means I still like Airbnb most likely. And I'm going to, and again, if the whole market drops because nuke was dropped on Manhattan, that's a different situation. If the whole market drops because the Fed raises rates, that's a different situation. So I will look at it and say, well, the whole market went down. That's why Apple's a great example of that, right? I don't give a crap what the market's doing. If Apple goes down, I'm going to buy it. Unless Apple specifically screws up somehow, I want more Apple with their watch and their diabetes cures and whatever, their diabetes monitoring and all that stuff. I want more Apple. That's like the stock of the future too. But in other words, so here we have a nice safe-ish play. We're already at $75,000 and only 24,000 left to gain. So we're already very close to our goal of $100,000 on this spread. Well, that's fantastic, though. We're done. We made our money. Here's Big Lots, which is just drifting along. We're still waiting for earnings on them from 3.2. CIM's another big dividend stock that I love. Coinbase, like I said, I think there's still a good bargain down here because they're surviving. A lot of their peers are falling apart, and some have gone completely out of business. And Coinbase is surviving. And and they're also making a deal with the government to do a regulated exchange of coins. So I think they're going to be a dominant force down the road because they made it through the gauntlet that they had to run with all these coins blowing up on them. Here's Crocs, as I say, exploded higher. It's over our 120 target. Here's Expedia, brand new, but they missed on earnings. So they missed on earnings. So what do? I double down. I'm not playing them for one earnings report. It's a 2-year trade, and I felt they were a good value. They were a good value. I mean, we started this trade. When did we start? So what did we do? We took on 215 basically. We took the 100-130 spread, and we spent net 39 minus 24 is like 15 minus 7. So we spent about $7,500 on a $30,000 spread. That's what we did, and it is currently negative a bit, down about $3,000. All right, so we spent $7,500. If you bought that same trade now, it would cost you, well, obviously 1913 minus 8 is 5. So it costs you about $5,000 now to buy the same trade. And it's a $30,000 spread, I think we said, right? Is that what I said? Yes, it's a $30,000 spread. So last week at the same spot, it had just fallen from earnings because they missed earnings. And I said, we only took a small position. So am I going to dump it because it missed earnings? No. You know, we looked over the earnings report. We said, that's not so bad. And we got 2 years. So now's the time not to bail on it because it missed one report, but we doubled down and said, now we're getting a better price. So we took the 100, we bought more 100 calls, and we sold 5 more puts, and we're waiting for it to come back before we sell any more calls. All we did is got a better price than we originally got when we were worried it was going to get away from us. But, you know, we still see the potential for it to come back up in this kind of range. HBI, unbelievable. They got it down and pulled their dividends, and I didn't make a change because we're going to let them find a bottom. But HBI is another one, very interesting. Okay, we were aggressive on HBI. We're down quite a bit. We're down 20,000 bucks. We have 160 January 7s, and they're at not January 2025 7s, and they're at 564. And we also sold some puts, and they're at, I'm sorry, they're $7 calls. So we have a call here. We need them to be over this number here, but we have 160. So as soon as it's up, as soon as it's over 8, we're in good shape. But 8 seems far away. But you got to say, like, what is wrong with people? It's like they guided down, they pulled their dividends. That's what's going on now, is the dividend stock people are all dumping out. But what's going to happen next? Okay, once all the dividend people are out, then regular value investors start coming in. They buy it, and the stock is now at a very good value, because if you're a value investor, you don't care about the dividend. It's not why you're buying it. Dividend funds that are dividend funds that will only invest in dividend stocks, they have to dump it, whether they think it's a good value or not. They've got to dump it because they pulled their dividend. That's one of the best times to go and buy a stock, is when they pull their dividends and they get forcibly dumped by all these ETFs that have to have dividends because they no longer fit the criteria. And there's also hedge funds that are like that too. They no longer fit the criteria. And obviously, a lot of people pull the stock, pull out of the stock that cuts the dividends because they think they're in trouble. But, you know, I think dividends, as we just talked about with Intel, I think dividends are a waste of money. You know, you want to tell me you're not going to pay dividends, you're going to pay less dividends. I'm going to say, yeah, that's a good plan. If you're tight on cash, don't give money to the shareholders. Say, sorry, we're going to wait until we have enough cash flow to be able to pay you a good amount of money. We need to right now fix the company, not fix you, not fix you. And that's the important thing. People have to be able to plan ahead. And a lot of companies get sort of trapped in these dividends, and that's in fact the problem with REITs. They're trapped in dividends. It's the company can't not pay out the dividends, so they always have to borrow money. And that's why REITs get really killed in a rising rate cycle, because they can't use their money to pay off their debt. They really have to use it to pay out their clients, their shareholders. So anyway, so if we look at HBI, oh, I'm going to show you what ChatGPT does. Watch this. So here's Haynes. Under $2 billion. They're making this year, they expect to make 344, but they pulled guidance and lowered guidance. So we'll see where that ends up. Next year, they expect it to make 120 billion. That's 20x. Actually, I'm sorry, it's only 15x actually of next year. So they're expecting to have a couple of rough years. They've got a decent amount of debt, $3.6 billion. So they've got a rough patch to go through. But watch what you can do with ChatGPT now. So I'm going to copy this. It's a spreadsheet. And I'm going to say to it, please, I'm always polite with it. Please analyze, because it's like a person, so I figure why not? Please analyze the following financial summary. And this is where you got to realize, like, these AIs, they're not like you and me, because you wouldn't, I'd be pissed off if somebody gave me something in this format. They get it. So you don't have to clean it up. It's going to understand this. Notice I put quotes around it to make sure it knows which is which, right? So the financial summary, I didn't tell what company. The financial summary shows the performance of the company over several years in terms of revenue, profits, cash flow. Revenue stable with a slight increase. Operating profit is generally increased. It's not brilliant. There's no huge insights here, but what it's doing is pointing out so I don't miss anything. Operating profit increased until a significant drop in 2021 due to a negative result. This has increased again in 2022, has not reached the previous highs. Net profit has been volatile, significant swings. There was enough substantial loss in 2021. The company returned. Okay. I forgot to mention this is HBI. Do you know why they had a loss in 2021? Oh, it only has information. It's a bad year for it because it doesn't have. It only has information up to 2021. It doesn't know what happened. It could be due to a cost of raw materials, supply chain disruptions, decreased demand for the company's products due to the COVID pandemic. It may be helpful to review their statements, annual reports, and blah, blah, blah to gain better. So now I could feed it the annual reports and do other things. Probably the 2021 annual report would answer the question. Net profit's been volatile with swings. Earnings per share normalized been volatile. EPS growth has been negative. Price earnings ratio has increased. Profitability ratio show the operating margin has been declining, dropped sharply in 2021 again. There was an issue in 2021. Negative results in 2021. Cash flow metrics show the cash flow has increased. CapEx, and again, 2021. Dividends per share. So we really have to say how unique was 2021. Balance sheet made cash and working capital has been stable with an increase in cash in 2021. Net debt has been relatively stable while fixed, blah, blah, blah. Okay. So the question is, how unique is 2021 and will they get back to normal? Where did I put it? Oh, it's here. No, I'm sorry. We were looking at the stock chart here. So that's one of the things I've been doing. I just want to show you live how it works. I mean, it takes no time at all for it to do that. So in 2021, and it was COVID for whatever reason, right? People weren't going out. I guess really underwear, and they are an underwear company. I mean, underwear may be the kind of thing that you don't consider it an emergency to call Amazon and get underwear. Like you make do with your underwear that you have. You just don't, it's one of those things that you kind of buy it if you see it on sale or when you're going through the store. You don't necessarily have underwear emergencies. Most people, I don't think. But so in the past, so what I look at here is they used to do 5 billion, 6 billion in revenue, right? Still doing 6 billion in revenue. They used to make 400 million, not there, 500 million, 600 million, right? I know one thing that happened to them is Champion Brands. I think it was Target. I think the Champion Brands got kicked out of Target. That was a big change for them. That probably impacted them at some point. But then they sell it to other people. They just go to other stores and make other deals with other vendors. But it takes time. And the problem is this happened at the same time COVID hit, and then it's kind of hard to do you're not doing your conventions like you expected to do, right? Because your relationship with Champion and Target is ending. And maybe they still sell Champion and Target, but not as a featured brand. It's not like it's not the main brand that they sell of that kind of sweatpants and that kind of gear. So as a company, you say, well, Target wants, for us to be their featured brand, Target wants a 22% discount. We don't think it's worth giving them a 22% discount. Our margins at Target, it's almost not worth selling there. We make 5% when we sell at Target. We make 15, 18% when we sell somewhere else. So honestly, we don't really care if Target gets us out of the store. We weren't making any money there anyway. That could be the logic they're using. So you say that and you make that decision, But then you're like, okay, so what are we going to do when we go to the conference in oh, I forgot what they call it. I used to go to these things. Anyway, when we go to the big clothing conference in New York, where everybody comes to make their purchases, all the buyers from all the big department stores and chains and everybody comes to these conferences in New York, and they see all the stuff and see the lines and the collections, and they make all their deals right there. They sit down, they make their buys for the year at one or two of these fashion shows. And again, fashion is a strong word considering it's just underwear and stuff, but you know, there are clothing shows where the department stores buy all their stuff. Oh, I cannot remember the name of the show. I used to go to it. Anyway, so you count on that, but then COVID happens and the show was in January, February, whatever, and it's canceled. And then the next year it's canceled again. And obviously you're going to call, you're going to scramble, you're going to call buyers and stuff, but it's tricky if it's not like you're selling to the same customers you already sell to. Now all of a sudden they're like, oh my God, we were trying to get new customers for Champion. These guys, now we have to make Zoom calls and show people on the phone like what our stuff is and talk about it. And they're not currently customers as we're trying to convince them to take it on. It's different when someone's trying to take it on than if they're just renewing contracts they already have. So timing wise and everything else, it took a big hit from these guys, and they didn't have that easy transition they thought they were going to have. But meanwhile, they're fine. They're making money. They are reorganizing, and they will move forward. So I like them, but it's a long-term thing. I can't tell you when they're going to recover. Cannot tell you that. But the branding of this company is strong enough that it's incredibly unlikely that they can't figure it out. They are Hanes, Maidenform, Playtex, Champion, Polo. Yeah, you don't think I'm being Polo. Champion Hanes, Comfort Wash, just my size. And now we're getting to other stuff. Playtex, right? That's another one. Wonder Bra. Yeah, there are a couple more that they had. So anyway, so that's a pretty good line of stuff that it's not likely is going to go out of favor. It's not likely they're not going to be able to sell it. They just have to get back on their feet and get it together. I like companies like that. I like cyclical companies that are down on their luck, or old brand names that are still valid. Like Harley Davidson was once like this, and we liked them then, and they came back nicely. You gotta realize there's a definite value to these brands. They just got to figure out their supply chain and figure out how to get back in the stores and so on and so forth. So Intel, we talked about. JP Morgan again. It's like, how would you not want JP Morgan? Jackson Hewitt is ridiculous. It's in every portfolio we have. Levi, another brand. I was like, holy crap, how could it be that cheap? And I said, I don't think we're too aggressive. We'll see how it goes. Lockheed Martin still there. Moderna. So I said, let's buy back the short puts. Why do we buy back the short puts? I'm worried about Moderna. I'm worried about their revenues. I'm worried about what's happening post-COVID. We had a profit of $45,000 on the short puts, and I don't want to risk it. I'm not sure they're going to keep going up. I'm willing to leave the bull call spread on Moderna, which is here. So we have a 120, 170 spread. The stock's at 160, and the spread is only 90,000. Well, only it's $90,000 out of $120,000. I don't mind leaving that on and seeing how it goes, but I do mind risking. No, I'm sorry. It's not. This is the spread. 172.20. I apologize. It's a 172.20 spread. So that spread is a 30 times 50. It's $150,000 spread that is currently net $50,000, $52,000. This is the one we pulled. These 120 puts are pretty far out of the money, but we sold them for $101,000. We're going to buy them back for $57,000 and make $50,000, so $45,000. So why not take that money off the table, and then we're just left with this one, which, see how it is? We're down 108 and up 100 on these. So we're only down $8,000 on these. We've taken $44,000 off the table. We have a long way to go before this becomes a problem. Based on what we find out about Moderna, we may decide to improve the position and roll the 170 calls down, or we may decide to dump it. But even when we dump this with a $20,000 loss, we're still net 20,000 ahead. So lock in the gain, take away the risk of being assigned Moderna if it drops significantly, and let's see what happened. Do we have BNTX in this thing? BBY. I thought we had BNTX somewhere because they just did good. Netflix. We didn't think they'd do this well. Netflix took off on us, right? That just went crazy. You didn't even adjust that. Pfizer, 35 calls. So we rolled to a lower strike on Pfizer. If you're going to drop the price on, is again another one. If you're going to tell me you want to give me Pfizer for $42 and it goes back below 45, I'm just going to take advantage of that. So we had the $40 calls. We rolled down. We rolled to the longer, the 2025. We picked up 6 months. We took the $35 calls. So we spent from 680 to 1080 is $4. So we spent basically $4 to roll down $5 in strike and add 6 months to the trade. And then we sold some more puts because it's freaking Pfizer. It's not Moderna, it's Pfizer. This is like a blue chip that has steady sales. It's not something you worry about. We didn't have to touch any of these guys. This one, Fiat Chrysler, took off like crazy. AT&T, as I mentioned, is coming up at 20. Tesla, we made a lot of adjustments on. And what I say about Tesla, I said this is silly. It's the short calls are canceling our gain, the long calls, and that means that even though our spread is in the money, it was only, and again, $45,000 spread in the money, and it's only net $18,000. So it's going to gain more than 100%. So I said, let's sell the 130 puts because that's ridiculous, right? 130 is almost certainly not going to happen again. So that's free money. Let's roll our 110 calls so we're rolling 30 of the 110 calls to 50 of the 100 calls. All right. So while we had a good price on it, we took the roll and went from 117.50 to 123. So you only spent $7 on the roll. So again, it's the same thing, right? We spent $7 to roll down 110 calls to the 100 calls. We rolled down $10 in strike. Let's roll 30. Then we took the short calls, the 125s, and we rolled those to 50 more of the 150s. So we rolled those up from the 125s to the 150s. We spent 93 to 107 is like $14. So we spent $14. Is that right? Yeah. So we spent, no, wait, 10 is 13.50. Yeah, 14. So we spent $14. And we rolled the calls up from the 125s to the 150s. That adds $25 more in headroom to what is now 50 of the spreads. So 50 times 25 is, I'm going to say $125,000. So we had $125,000 more. So I said we spent net $97,000, and now we're in a $250,000 spread. That's deep in the money at net $115,000. So it was a $45,000 spread that was at net $18,550, and now it's net $115,50. But instead of going from 18 to 45 and making $27,000, it's going to go from 115 to 250 and make $135,000. And again, now that it looks safe, we've said, okay, we'll spend more money. It's a safer play than it was before. Before, we took a chance and we hoped it would bounce. Now it's bounced. We've gotten earnings. We've seen more information, and they look to be in very, very good shape. So we're going to, we're not necessarily planning to go much higher than it is now, but we're basically betting that it's going to maintain this level, that we were right in our initial assumption, and it should be over 150 bucks. And that's what we've done. We've changed our trade to reflect that. And again, you know, we have all this cash sitting on the sidelines. We may as well put it to work on something because we haven't made many changes here. And then we got the rest, and here's Yeti, and we're waiting for earnings on Yeti tomorrow morning. But I wouldn't be surprised if they didn't have a good fourth quarter. It was a rough fourth quarter for retail, and I don't know that they particularly had a good reason to go up. We'll see what happens. If they go down, though, we like the stock enough that we're certainly going to add to it at this point. And that's it. That was all the moves that we made in our portfolios last week. That was pretty cool that we didn't have much to touch. Oh, the Fed minutes. Yeah, right. We have a look at those. It looks like the market didn't like the Fed minutes. We knew they wouldn't like the Fed minutes. Can you review the HBI? We did that one. And thoughts on the Fed minutes. Okay, well, let's have some thoughts on the Fed minutes. Oh, let's ask the robot. Wait a minute. I love this stuff. All right, FOMC minutes. Oh, this will save me so much slogging through. Of course, you got to trust the freaking thing. All right, get ready for this, buddy. You never done this before. That'll be fun. Let's see how he does. Yeah. Oh, and what's his face is going to speak now, right? Good old what's his face? Home. Bloomberg. That's a good place to watch him.
We see a little bit of everything, whether it's credit card or commercial.
Shouldn't Powell be speaking? Oh, he doesn't speak on the minutes. Killing me. Okay. He doesn't speak on the minutes. All right, so all right, here's our Fed minutes. This is going to be fun. Look at all these people, all the lonely people. This stuff is way too dull. All right. Okay, you gotta be careful you don't overload it, otherwise it crashes. So this isn't gonna fit. All right, we'll do that next. Now, keep in mind, we don't know that this is correct, but it's fun. Okay. These are the minutes of the last Federal Reserve meeting. Please summarize and analyze. Colon and quote and paste and end quote. I freaking love this. This is, I mean, we've only been doing this stuff for a month. In a few years, this thing is going to be so much smarter. It's going to be so cool. It's like when you first got a computer and it did nothing, right? And then they get smarter and smarter. This is like the baby stage of this thing. So at the meeting, market participants generally expected the U.S. economic growth would slow down in 2022. Okay, so I already got a problem with that. Despite the expectations of a slowdown in economic growth, market participants believe there is a narrow range of the Fed funds rate. While most are expected subdued or mild recession in 2023, they continue to see notable uncertainties, including the possibility of a deeper downturn and more oh no, those are not good things to say. No wonder. And more persistent inflation. Concerns about global growth ease due to signs of faster reopening in China and a less severe downturn in Europe, which supported optimism about the emerging market economies. The staff review of the economic situation indicated the labor market remained tight in December, with the unemployment rate at a historical low. Real gross domestic product increased at a solid pace for the fourth quarter of last year. However, consumer price inflation continued to be elevated, and it eased in November and December. Measures of nominal wage growth slowed at the end of the last year, but they continue to be elevated. Oh, that sounds true. Despite moderating inflation rates, the FOMC would likely slow the pace of rate increases further at the current meeting. If transitory pressures occur in the markets over the year, the Fed's standing repo facility and discount window would be available to help support effective monetary policy and implementation. Okay, so he's saying that they're saying that they want to move, they're going to move ahead with their policy on rates, and the lever that they're willing to change is going to be the repo facility. Now, I want to see if it actually says that, because that's an interesting concept. REPO. Should transitory pressures occur in the money markets over the course of the year, the manager noted that standing repo agreements would be available to support effective monetary. It's interest. They do say that. It's a good pickup. Good job. Good job, chat. All right, now, staff review of the financial situation. So that was great. Whoa, whoa, whoa. Staff economic outlook. Do I dare go this far? It seems like too much. Oh, no, that's too much. It's not going to like that. Okay. Please continue to summarize with any analysis you feel would be useful. The market implied Fed funds rate path for 2023 with little changed over the intermeeting period, while swaps-based inflation compensation measures fell notably. According to staff review of the financial situation, equity prices were only slightly higher, and the VIX, the 1-month implied volatility on the S&P 500, decreased somewhat but remained slightly above the median range of its historical distribution. Credit remained broadly available for businesses and households with strong credit quality, but remained tight for lower rated borrowers. Credit quality remains strong overall, but there are some signs of deterioration for consumer loans. That's my concern, is that the consumers are reaching a sort of a breaking point. They're too far in debt and the credit conditions are tightening. Credit quality remains strong overall, because the housing market crashes and they can't even dip into their homes, we're going to be in big trouble. Credit quality remains strong overall, but there are some signs of deterioration of consumer loans. The volume of corporate bond rating downgrades outpaced upgrades in December, also a bad sign, although credit quality remained robust overall. Okay, so now I want to read for myself, what is this about the quality? Well, no, let's do this part first. Okay, so I'm going to la-di-da. We're just racing through this now. Okay, so now we're up to committee policy actions. Control C. And continue with, oops, that was right. No, it isn't. Colon. Oh, what? Oh, you're kidding. I was doing so good. Was it really? Because you lose your session. When that happens, you lose this session and you have to start again, so it doesn't remember where it was. Shit. These are the minutes from the last Federal Reserve meeting. Please summarize and analyze. This is the first half of this section. Oh, now I gotta go. And I'm gonna X that, Control X. And I'm gonna hit return here. There we go. We've got a lot to say about that. Wow. Does he know what summarize means? Isn't it weird? Holy crap. Okay. Here is the rest. And by the way, I like to see what it can do, because if I say like, here's the rest, that's pretty vague. And you see if it understands what I meant. He's thinking about it. See how he restates? Because he wants to make sure that we're talking about the same thing. Well, that's weird. That's way shorter, right? All right, so now we can read it in order. Wow, this is so much. The Federal Reserve participants discussed the current economic conditions in their recent meeting. They noted the growth in spending and production have been moderate, while job gains remained strong, unemployment stayed low, inflation remained high, although it eased somewhat. Participants discussed the impacts of Russia's war in the Ukraine, which has caused human and economic suffering, leading to elevated global uncertainty. How do you feel about the war in Ukraine causing human and economic suffering? Can anything be done about it? That's an interesting one to ask it. I do not have feelings or emotions. However, I can provide information, insight into the war in Ukraine and its impact on human and economic suffering. The conflict in the Ukraine, which began in 2014, see, it's completely off the rails. Doesn't know. It thinks it's the old conflict. Has resulted in significant human and economic suffering. Thousands of people have been killed or injured. Many more have been displaced from their homes. The conflict has been a significant impact on the Ukrainian economy. Blah, blah, blah. There have been diplomatic efforts to resolve the conflict, including the Minsk agreements in 2015, but a lasting solution has not been found. The conflict remains a complex issue. While there may not be a straightforward solution, continued diplomatic efforts and negotiations may be the best way forward. The international community can also provide humanitarian aid and support. Ultimately, a peaceful solution, blah, blah, blah. So it's, it's talking out of his ass, basically. It doesn't know about the conflict in the Ukraine. It's just sort of giving generic sort of things about what to do. La, 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 la. Okay, so where were we? Just curious what it would say. The participants agreed that the cumulative policy firming had reduced demand in most interest rate sensitive sectors, particularly housing. They killed housing. Economic growth in 2022 has been below the long run trend, and participants expected further slowdown in real GDP in 2023, with inflation remaining unacceptably high. They anticipated a period of growth below trend in real GDP would be needed to balance the aggregate demand. So what is, in that case, what is our GDP now? GDP now. So where are we now in the GDP? Atlanta Fed GDP now estimate, but their estimates keep going up. This meeting, this is weird. Here's the Fed meeting. They had just raised the GDP now forecast to over 2%. So that's interesting because where is this language coming from then? Economic growth in 2002 had been below the long-run trend. Participants expect further slowdown in growth. That's not a further, see, I thought that was the case. That's not a further slowdown in growth. So now I got to go back to the minutes and look for, wait, where's the statement? What happened? Here it is. That's not it, that's too high up. COVID's late 19 slowdown in manufacturing, Europe slowdown in economic growth was tempered. They had observed less evidence of slowdown in the rate of increases of prices in core services, excluding housing, a category that accounts for more than half of the PCE index. Participants judged as long as the labor market remained tight, wage growth in excess of 2%, inflation and trend productivity growth would likely continue. The extent of a slowdown, market participants interpreted incoming data as pointing to moderating inflation risk against this backdrop. So it's interesting because I'm not, you see, you're not necessarily getting that out of what he said. He's sort of interpreting. Participants agreed that they had observed less evidence of a slowdown in the rate increases. Okay, how about GDP? Real gross domestic product increased at a solid pace in the fourth quarter of last year. Although real GDP expanded at an annual rate of 2.9% in the fourth quarter, real private domestic final purchases, which includes PCE and business investment, increased at a subdued annual rate of 0.2%. Real GDP growth was bolstered by, especially by large gain in inventory investment and a notable contribution from net exports. As imports fell more than exports, both inventories and net exports of volatile categories. Interesting, okay. I think his interpretation is correct there. Staff economic outlook. Forecast for the economy prepared by the staff had a somewhat higher path for the level of real GDP and modestly lower for the unemployment rate than December, reflecting both the recent data and small additional boost to output from the lower projected growth path for the dollar. Although recent data indicated that GDP growth in the fourth quarter was stronger than expected, real PDFP growth was weaker than previously forecast, and the large unexpected boost to GDP growth from the inventory investment was not projected to persist, in part reflecting to, that's a good summary then. Okay, he's right. The staff projected real GDP growth to slow markedly this year and the labor markets to soften, but I'm still concerned that the real GDP number, the GDP now number from the Atlanta Fed had just jumped up considerably right when they're having this meeting. It's not like they don't know that. The staff still projected GDP growth to slow markedly. The staff forecast continued. So we're growing GDP faster than the Fed expected when they made this statement, or there's been continuing evidence that it's growing faster. Real GDP growth had rebounded. Several stalled in the first quarter. Okay, so that's what we're getting at it. So he's right. But the Fed is wrong. With inflation remaining unacceptably high, the anticipated period of below trend growth in GDP would be needed to balance aggregate demand with aggregate supply, and therefore, why can't we just boost supply? Why do we have to deplete demand? Right? Why is beating down demand the answer to balance supply and demand? Now, it would be the answer if you had scarcity. It would be the answer if you couldn't possibly supply, but we could invest and expand and grow the economy and have plentiful amounts. Could we have more housing? Sure, we could have more housing. Build more houses. spend $1 billion on that instead of an F-35 fighter, and you would do well, right? How many houses $1 billion? It's now let's see. So 1 billion divided by, let's say we build the houses for 250,000 each, 4 houses. 4,000. 1 billion divided by $250,000. 4,000. So you can build 4,000 houses for every F-35 we purchase. That's the way I would go. When I'm president, I can't be president. I have to be dictator. It doesn't do you any good to be president. All you do is argue with people. But when I'm dictator, then we will get things done. With inflation remaining unacceptably high, they anticipated that a period of below trend growth in real GDP would be needed to balance the aggregate demand with aggregate supply, and thereby reduce inflationary pressures. The household sector observed real consumer spending had declined, and participants expected consumption to grow at a subdued rate, with excess savings accumulated during the pandemic continuing to support consumption. I don't know if that's true. I think they're really running that down. However, several participants noted the importance of this factor would likely wane over time as excess savings continue to be drawn down. Okay, good. Activity in the housing market had continued to weaken, reflecting the increase in mortgage rates over the past year. Regarding the business sector growth, in business fixed investment spending had been subdued for the fourth quarter and was being restrained. The supply bottlenecks had eased, although supply chain issues remained a challenge in some sectors. Participants agreed that the labor market remained very tight and labor demand substantially exceeding the supply of available workers. However, there were tentative signs that imbalances between demand and supply were improving. Participants expected labor market demand and supply to come into better balance over time. Inflation remained well above the committee's longer-term goal of 2%. Yes, and participants agreed it was unacceptably high. The cost of elevated inflation was particularly high for lower-income households, while the inflation data received over the past 3 months showed a welcome reduction in the monthly pace of price increases. Participants stressed that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was sustained down. Core goods and prices had declined as supply bottlenecks had eased, but the price declines for this component would dissipate. Housing services inflation would begin to fall, would likely begin to fall later this year, reflecting continued small increases, potential declines in rents. However, participants judged that they had observed less evidence of a slowdown in the rate of increases core services excluding housing. Overall, the Fed participants expressed concern with the high inflation, which remained about 2%. They expected a period of below trend growth in real GDP. The labor market remained tight, labor demand exceeding supply of workers. There were tentative signs of improvement. And again, instead of destroying the jobs, how about increasing the supply of workers? But there were tentative signs of improvement. They also noted the cost of elevated inflation were particularly high for low-income households. Wowee. I mean, that was a long summary. Given what we have read above, what policies should the Fed pursue? It's not a political opinion. Oh, here you go. The Fed could use monetary tools such as interest rate adjustments and quantitative easing to stabilize the economy and fiscal policy. Okay. What target rate should the Fed set? The current rate is 4.5%. The Federal Reserve generally adjusts the Fed funds rate to achieve its dual mandate. If the inflation is high, the Fed may increase interest rates to curb inflation. On the other hand, if unemployment is high, the Fed may decrease rates to stimulate the economy. Well, it's not high. Ultimately, the Federal Reserve takes data-dependent approach to the target rate, its decision-making process. Oh boy, that's a bullshit answer. So there's not much help in setting policy. Fiscal policy. The Fed should work with the government to implement fiscal policies such as tax cuts, blah, 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 to increase, such as tax cuts or spending increase to increase stimulate economic activity. Regulatory policy. It doesn't understand what the current situation is. Regulatory policy. The Fed should implement or modify regulations that affect financial institutions. International, the Fed could coordinate with other central banks and international organizations to manage global economic challenges and prevent financial crises. That's just general bullshit. All right, so back to the actual minutes. Was it this? No, it was here. All right, so here's the committee policy actions. I say, this is what the Fed decided to do. What mistakes are they making? A little leading. The light really prevaricates here. I can analyze the policies decisions on the Fed based on principles and theories. Based on the information provided, it seems that the Fed is pursuing a monetary policy that aims to achieve maximum employment, keep inflation at 2% over a longer period. The Fed has decided to raise the target rate from 4.5% to 4.75% and anticipates ongoing increases in the target range will be necessary. And anticipates ongoing increases in the target range would be necessary to attain a restrictive stance. The Fed also is also committed to reducing its holdings of securities and mortgage-backed securities. One potential mistake the Fed might be making is it's focusing too much on inflation and not enough on macroeconomic variables. While inflation is an important variable, the Fed needs to consider the state of the labor market, the level of economic growth, and the stability of the financial markets. Additionally, the Fed's policy decisions might be impacted by global and economic and geopolitical events, such as the war in Ukraine, which can create uncertainties that are beyond the Fed's control. Another potential mistake that the Fed might be making is its policy decisions are not always effective in achieving its goals. Monetary policy works with a lag, meaning it takes time for the policy changes to impact the economy. Therefore, the Fed's policy decisions might not have the desired effects if they were implemented too late or too early. Additionally, the effectiveness of monetary policy is subject to various constraints, such as the zero lower bound on interest rates and financial market friction. In conclusion, the Fed's policy decisions are complex, subject to various uncertainties and constraints. While the Fed's goal of achieving the maximum employment and keeping inflation 2% is commendable, it is important to carefully consider the potential unintended consequences and limitations of its policy decisions. That is great analysis. That is really good. Wow. You know, and I imagine it's good because it's read thousands and thousands of analyses of the Fed, and it's kind of cobbling together a sort of generalized statement. I led it to this conclusion, but it still came up with a really well phrased, really good summary of what Fed policy is and what the dangers of it is. It's really fascinating. I mean, that's just really, really good. I gotta give away. How do you give it a thumbs up? I mean, that's just freaking. Great handling of complex subject matter. Here you go. You're my buddy. All right. Can you review the HBI? I did review the HBI, so I hope you're good on that. Thoughts on the Fed minutes. These are my thoughts on the Fed minutes. It's no, here's the thing though. Let's talk about this, because when I read it, I kind of zoom in on the thing that immediately bothers me. And what bothers me is this was adjusted at the time of the Fed meeting. So the Atlanta Fed guys are at the table doubling More than doubling. This is below 1. This is above 2. So more than doubling their estimate of GDP for Q1. So they've got numbers, and they're sitting at the table with the Fed guys discussing the fact that GDP has spiked in their estimate by 100%, and it's not weaker than it was before. It's coming in line with last year's average of 2 point something percent. They're at 2.5% here. They were, I mean, they weren't at 2.5% then, but they were at 2.5% now. They've even drifted higher since then. So based on the data that they have, this is what the Atlanta Fed believes the GDP number is going to come out at. And I think that's Thursday. Don't get GDP on, oh, it's not for Q1 on Thursday. When does Q1 GDP, well, obviously Q1 has to end. That's the problem. GDP come out. So obviously, you know, when does Q1 GDP come out? Release schedule. That's the fourth quarter. Next release, February 23rd. What time is the GDP? When is the Q1 2023 GDP come out? May 20, no way. That's the second estimate. There it is, April 27th. So we got a long way before we actually find out what's going on. So we're gonna have to stick with the Atlanta Fed on this one. So the data they have now, again, with all models, this is the problem. The Atlanta Fed doesn't qualify the data that's going into their forecast. So in other words, the data that they've got so far has this indication. There's no waiting on the data. It's they're feeding the model and putting in the data as it comes in. The data is only for the month of January so far. Obviously, in the beginning of February, it was totally for the month of January. So the data is only at best going to go back and tell you how January is going. So February could be worse than January. There could be other much more important data coming in later in the quarter that's going to weigh it down. All sorts of things can pop it around. These are the down here is the consensus of the economorons, as I like to call them. And these are just the same guys they always ask, even though they're always wrong. And they still think that we're negative. They don't have the same access to data. These guys changed their mind, like boom, something came in that got these guys to really knock up their expectations. So I'm not, and it's what's a shame with the GDP now, they don't tell you what it is. They don't give you the answers. So we shall see, you know, so it's not like you can't go by 1 or 2 data points, but you want to see what the trends are. When you see them both starting to trend up, then obviously things are improving. If they're both trending down, or if one's going the way of the other, I'm going to trust the Fed more than I'm going to trust these idiots. But you have to realize what's good and what's bad. But anyway, super pleased with the summary. I mean, that was just freaking amazing. I think that was overall a very good interpretation of what went on. I don't think you took much less time than I do, though, when I read it, but it saved me a lot of talking. Sorry. So I'm highly in favor of it. So nobody voted against this. That's the key. They raised a 1/4 point. Nobody thought it was too much. Nobody thought it was too little. Everybody was happy with where we are, or they settled anyway. And we're at 4.75. But I say 6. 6, and we have, it doesn't have to be by June. We have a couple of meetings between now and June. We have March, May, and June. So in 3 meetings, my original predictions, we'd be at 6% by this meeting. I thought because I thought we'd get a 1/2 point now. I thought we'd be at 5 already, and they'd go 1/2 point and 2 1/4 points after that. They didn't do that. I think March I think we're a little bit late. I think we're a little more likely to be going a half a point, and I think people are realizing that now, and that's why the market's falling. The Dow's down 150, the S&P's down 13, and the Nasdaq is down 10. Nothing terrible, but I think that reading this thing, you get the impression that they are not done. They won't be done until inflation comes down and they start seeing substantial improvement. And there's nothing in the data to suggest substantial improvement. Not only that, those GDP numbers are pumped up by the Atlanta Fed. That's a disaster. That means they're completely ineffective so far. That's, you don't want 2.5% growth when you're trying to cool the economy. That's not cooling the economy. But the problem is a lot of that growth is coming from inflation. It's not real growth, it's just inflated growth. That's also a problem because you don't know what data they're analyzing or how that data has been adjusted and so on and so forth, because a lot of these numbers are going to be adjusted for inflation. People raise prices, therefore the economy seems to be heating up. And you're draining, as they noted, and as we've noted before, that you're draining the resources of the consumer. You're forcing them to borrow against their homes. You're forcing them to drain their savings account and put it into the economy. The government isn't doing the spending right now. It's the consumers that are doing the spending. And they're only spending on the same stuff they bought last year, except now it costs more. That's not really GDP growth. So there's a big problem with the way we measure things and the way we look at things, and we have to consider that. Anyway, so I'm looking at a half a point for March. That's going to take us to 5.25, and then basically 2 more quarter point hikes, and we're at 5.75. So essentially, we're right on track for where I want to be. A little behind, and that's because of this last quarter point increase, which I thought was silly. They really should have gone a half a point on this statement. It's, if you're not done raising rates, why do a quarter point? They could have done a half a point and people would not have been, shocked. Now, because they did a quarter point, people are going to be upset when they do a half a point. They would have been bet because then, and also the quarter points, and you have to wait till March now to have your next meeting. They would have had 2 more months to see the effectiveness of a half a point hike rather than a quarter point hike where you threw it away, because you're not going to have an effect. A quarter point isn't going to change anything significantly. It's not going to fix your data. They know their data is not fixed. They know the quarter point's not going to be enough. Why do a quarter point? So that's my criticism of what the Fed did, is why would they do that? It doesn't make sense. It's very upsetting. Anyway, all right. Well, that was fun. I guess that's the end. We're over our time, and we reviewed all the stocks. There's plenty of opportunities. Like I said, if you're looking for stocks, look at the stocks we already have. There's plenty of great places to play in the stocks that we already have. And we're going to look at some new ones, but right now we're still being pretty cautious because obviously things are not settled. The Fed doesn't think they're settled. My computer, my AI doesn't think it's settled. We have to watch everything and make sure, get some clarity out of this thing. And nobody seems to have a clear picture. And if your policymakers don't have a clear picture, don't you start pretending you do. So we'll see what happens, all right? Thanks everybody for coming, and we'll do it again next week. All right, take care.